Okay, let's unpack this. We are diving deep today into a number that's so immense, it feels almost abstract. The U.S. national debt. We're talking about a figure that's reached truly staggering proportions, trillions upon trillions of dollars.
It's hard to even wrap your head around sometimes.
Exactly. It's easy to just hear that number and move on.
Yeah.
But have you ever stopped to think about where that money actually comes from?
Right. It's not conjured out of thin air by some, government money tree.
Definitely not. When the government needs to spend more than it collects in taxes, whether that's for defense, social programs, infrastructure, maybe responding to a crisis, it has to borrow that money. And it does this through a process that is incredibly sophisticated, highly structured, and frankly, the engine that keeps the entire system running, yet most people never give it a second thought.
And that's what we're getting into today, right? The US Treasury Auctions.
Precisely. Treasury Auctions.
Yeah, think of Treasury Auctions as the primary marketplace where the U.S. government goes to borrow the money it needs.
The main borrowing mechanism.
Absolutely. It's a vital piece of financial plumbing, really. It channels capital from investors all over the globe to fund, well, everything the government does.
And it's not just about getting the money, is it? Though that's obviously important.
No, not just that. The Treasury has very specific critical objectives for these auctions. They want to, first, minimize the cost of financing this enormous debt over time.
Keep borrowing costs low. Makes sense.
Second, ensure there's broad and competitive participation from potential lenders. They want lots of bidders competing.
Okay.
And third, crucially, foster a highly liquid secondary market.
Meaning what exactly?
Meaning that once these securities are sold in the option, investors can easily buy and sell them among themselves later on.
So they're not stuck holding them if they don't want to.
Exactly. And that liquidity makes the securities more attractive to buy in the first place, which helps achieve the other goals like lower cost.
Okay, got it. And to borrow these, trillions, the Treasury doesn't just issue one simple IOU.
Right. No, definitely not.
Yeah.
They offer a variety of instruments, almost like a financial toolkit, designed to appeal to different types of investors with different needs.
So what are these fundamental building blocks the government uses to borrow? Let's start there.
Okay. Fundamentally, when the U.S. government borrows money on the open market, it issues marketable securities. Primarily, these are bills, notes, and bonds.
Bills, notes, bonds. Heard those terms.
Right. And while they're all promises by the U.S. government to pay you back, the main difference, the core distinction, is their maturity.
Okay, maturity. So how long until you get your principal back?
Exactly. It's the length of the loan, basically. At the short end of the spectrum are Treasury bills, or T-bills.
T-bills, short term.
Yep, these are the speediest. They mature in 1 year or less. You can find them offered with maturities as short as 4 weeks, then 8, 13, 26, and 52 weeks.
It's a pretty quick turnaround.
Very quick. And if the Treasury needs cash very quickly for a specific immediate need, they sometimes issue cash management bills, or CMBs.
CMBs. Never heard of those.
They can be even shorter than standard T-bills, sometimes just a few days or weeks, maybe up to about 3 months, really for short-term cash flow management.
Interesting. Okay, so bills are the really short-term stuff. Under a year. What's in the middle?
The medium-term instruments are Treasury notes, or T-notes. These come with maturities ranging from 2 to 10 years.
2 to 10 years.
Yeah. The most common are 2, 3, 5, 7, and the very closely watched 10-year notes.
Right. We'll come back to the 10-year, I bet. And for the really long haul.
That would be Treasury bonds or T-bonds. These
Yeah.
are the longest-term securities the Treasury issues, typically with maturities of 20 or 30 years.
30 years. Wow.
Yeah, sometimes people just call them long bonds.
All right, so bills are short, like under a year. Notes are medium, say 2 10 years. And bonds are long, 20, 30 years. Simple enough. How do they pay interest? Is the payment structure the same for all three?
No, and this is another key difference that affects how investors think about them. Treasury bills, the short-term ones, they don't pay periodic interest payments like a traditional bond.
No regular checks in the mail?
Nope. This is why they're often called zero-coupon securities in practice, although technically they are sold at a discount. You buy a T-bill for less than its face value.
Okay.
Your return, your interest, is the difference between that discounted purchase price and the full face value you receive when the bill matures.
Oh, okay. So maybe you buy a $1,000 T-bill for, say, $970.
Exactly. And then at maturity, maybe 6 months later, you simply get $1,000 back. That $30 difference is your return.
Simple. You make money on the discount. How about notes and bonds then?
Treasury notes and bonds work more like, well, traditional bonds. They pay fixed interest payments, known as coupons, every 6 months.
So you get regular income.
Correct. These coupon payments are a percentage of the security's face value, the amount printed on it. And then at maturity, in addition to having received all those regular coupon payments over the years, you also get the full face value back.
Can you give an example, like that $500 bond you mentioned earlier?
Sure. Let's say you have a $500 face value bond with a 5% coupon. That 5% is an annual rate based on the $500 face value.
Okay, so 5% of $500 is $25 a year.
Right. But it's paid every 6 months. So you'd receive $12.50 every 6 months, 2 payments a year, totaling that $25.
Got it.
And if it's a 30-year bond, you'd get 60 of those $12.50 payments over the 30 years, plus your original $500 back at the very end.
Okay, clear. Bills give you a lump sum return at the end from the discount, while notes and bonds give you that steady income stream along the way, plus your principal back. Now, the big draw for many investors, especially in times of uncertainty, is the safety of these things. How safe are they really?
This is arguably the single most compelling feature of US Treasury securities for investors worldwide. They are backed by the full faith and credit of the US government.
Full faith and credit. Sounds solid. What does that mean in practice?
In practical terms, it means the US government is obligated to pay you back, period. Historically, the US government has never defaulted on its debt obligations.
Never.
Never. This backing means that if you hold a Treasury security until its maturity date, you are considered virtually risk-free from losing your principal or not receiving your scheduled interest payments. It's about as close to a guaranteed return of principal as you can get in finance.
So, unlike, say, a bond issued by a company which could go bankrupt.
Exactly. A corporate bond comes with credit risk, the risk that the company might fail and not be able to pay you back.
Right.
To compensate investors for taking on that extra risk, corporate bonds typically have to offer higher potential interest rates, higher yields, than treasuries of a comparable maturity.
Makes sense. Higher risk, potentially higher reward.
It's a classic risk-reward trade-off. Treasuries, because of their perceived safety, generally offer lower yields, but it's really crucial to understand the held-to-maturity part.
Ah, okay. What's the catch?
Well, it's not exactly a catch, but while the government guarantees payment at maturity, if you need to sell a Treasury security before it matures, its market value can fluctuate.
Fluctuate based on what?
Primarily based on prevailing interest rates in the market and general market conditions. If interest rates go up after you bought your bond, newly issued bonds will pay more, making your older, lower-paying bond less attractive, so its price might fall if you try to sell it.
And the reverse if rates go down.
Correct. If rates fall, your existing bond with a higher coupon becomes more valuable, and its price might rise in the secondary market.
Okay. And how sensitive are those prices to interest rate changes? Does maturity matter there too?
Yes, definitely. Generally speaking, the longer the maturity of the security, the more sensitive its price is to changes in interest rates. It's about duration, technically.
So those 30-year T-bonds will swing more in price than a 2-year T-note if rates change.
Precisely. Their prices will typically move more dramatically up or down than notes or especially bills when overall interest rates shift. Bills, with their very short maturities, are the least sensitive to rate changes.
Is there one particular Treasury security that the market pays the most attention to? Kind of a bellwether.
Absolutely. The 10-year Treasury note. It's kind of the rock star of the Treasury market, you could say.
The 10-year note. Why that one specifically?
It's widely used as a benchmark, a reference point, for setting interest rates on a whole host of other loans. Most famously, mortgage rates often track movements in the 10-year Treasury yield.
Ah, okay. So it affects things beyond just government borrowing.
Very much so. It's a combination of a reasonable maturity, not too short, not too long, and incredible liquidity makes it extremely popular globally.
Liquidity meaning easy to buy and sell.
Extremely easy. There are always buyers and sellers readily available for the 10-year note. Everyone from individual investors to massive pension funds, central banks around the world, foreign governments, they all hold 10-year notes.
Wow.
And because of this high demand, especially as a safe haven asset during times of economic uncertainty or recessions, its yield movements are constantly watched and analyzed. They're seen as a key indicator of market sentiment about the economy and future interest rate expectations.
Okay, so these bills, notes, and bonds are the instruments, the tools the government uses to borrow. But let's step back for a second. Why is the government borrowing so much in the first place? Where does this multi-trillion-dollar national debt actually originate?
That's the fundamental question, isn't it? The national debt is essentially the cumulative total, the running tally, of every time the U.S. government has spent more money than it took in from taxes and other revenue sources in a given year.
So each year where spending exceeds revenue, that's a deficit.
Exactly. That's a budget deficit for that fiscal year.
And that deficit gets added to the total pile of debt.
Precisely. Think of the government's budget like a colossal household, or maybe better, a business budget. Revenue comes primarily from taxes, income taxes, corporate taxes, payroll taxes, excise taxes, etc.
Right.
Spending goes towards everything the government is responsible for. You know, the Constitution's preamble lays out broad goals like providing for the common defense, promoting the general welfare, which translates into funding for the military, Social Security, Medicare, Medicaid, infrastructure projects like roads and bridges, federal employee salaries, scientific research, national parks. You name it.
A very long list.
A very long list. When that annual spending exceeds the revenue collected in a fiscal year, the government runs a deficit. And to cover that shortfall, that deficit, it has to borrow money.
By selling these Treasury securities we just talked about.
Exactly. By selling bills, notes, and bonds through those auctions. The national debt, then, is the sum of all those past annual deficits piled up over decades, over centuries even, plus the interest that has accrued on all that borrowed money.
So it's like using a credit card analogy. Spending more than you pay off each year creates a deficit, and the total outstanding balance on the card is the debt.
That's a pretty good analogy, yeah. The annual charges beyond what you manage to pay off are the deficit for that year, and the total accumulated balance you owe, including interest, is the debt.
That makes it very clear. So the debt grows when there are deficits. Has it always been this large, or are there specific times it really spikes?
Oh, it's grown dramatically over time, and it often accelerates significantly during periods of national crisis or major policy shifts.
Like wars.
Wars are a huge driver. It started relatively small, maybe around $75 million back in the Revolutionary War era, mostly borrowed from wealthy individuals and foreign allies like France and the Netherlands.
$75 million sounds like nothing now.
Right. Then you see massive increases during major conflicts. The Civil War saw it jump from about $65 million before the war to nearly $3 billion by the end.
Wow, quite a leap.
Huge leap. World War I caused another big jump, and then World War II led to absolutely enormous borrowing needs. The debt-to-GDP ratio we'll talk about that spiked dramatically during World War II as the nation mobilized its entire economy for the war effort.
So wars are a major factor. What about more recently?
More recently, significant increases occurred during the 2008 Great Recession. Tax revenues plummeted as the economy contracted, and at the same time, government spending on stimulus measures and safety net programs like unemployment benefits rose sharply.
So less money coming in, more money going out. Classic deficit driver.
Exactly. And then, even more dramatically, during the COVID-19 pandemic.
Right, the pandemic must have been a huge driver of the recent debt growth we've seen.
Absolutely massive. In response to the economic shutdowns and the health crisis itself, government spending just soared.
On things like stimulus checks.
Stimulus checks, enhanced unemployment benefits, the Paycheck Protection Program, PPP, loans for businesses, massive funding for vaccine development and distribution, healthcare support.
Yeah.
The list goes on.
Yeah.
Between fiscal year 2019, just before the pandemic hit hard, and fiscal year 2021, federal spending increased by roughly 50%. 50.
That's an incredible increase in just 2 years.
It really is. This huge surge in spending, often coupled with disruptions to tax collection during the lockdowns, led to absolutely massive annual deficits and, consequently, a very significant increase in the national debt in a very short period.
When the number gets into the tens of trillions like it is now, it's just hard to grasp the scale. Is there a better way to understand the debt's burden relative to the country's ability to handle it?
Yes, that's a really important point. Economists and analysts often look at the debt to gross domestic product, or debt to GDP ratio.
Debt to GDP, how does that work?
It compares the total national debt to the country's total economic output, the GDP, in a year. It's generally considered a more meaningful measure than the raw dollar figure alone.
Why is it more meaningful?
Because it shows the debt burden relative to the size of the economy. It gives you a sense of the country's capacity to generate the income, through taxes primarily, that could potentially service or eventually repay that debt. A larger economy can, theoretically, handle a larger absolute amount of debt.
Okay. And where does the U.S. stand on that ratio?
The U.S. debt to GDP ratio surpassed 100% back in 2013, meaning the debt was larger than the entire annual economic output. It's remained above that level since, And it spiked even higher during the pandemic due to that surge in borrowing we talked about.
Over 100%. That sounds high.
It is high historically for the U.S. outside of the World War II peak. A higher ratio can indicate a potentially greater challenge in managing the debt sustainably over the long term, though there's debate among economists about exactly what level becomes problematic.
And the national debt isn't just one monolithic number, right? I think I've heard there are different components.
That's correct. Broadly, the national debt is divided into two main categories: debt held by the public and intergovernmental debt.
Okay, what's the difference?
Debt held by the public is the portion of the debt owned by anyone outside the federal government. This includes individual investors like you buying savings bonds or T-bills. All corporations, banks, insurance companies, pension funds, state and local governments, foreign governments like China or Japan holding large amounts of treasuries, the Federal Reserve itself, basically everyone else. This is the debt sold through those treasury auctions we're focusing on.
Got it. So that's the money borrowed from the wider market. What's intragovernmental debt?
Intergovernmental debt is the portion held by various government accounts, primarily federal trust funds like the Social Security Trust Funds and the Medicare Hospital Insurance Trust Fund.
How does the government owe money to itself?
It sounds a bit weird, but basically, these trust funds take in dedicated revenue, like payroll taxes for Social Security. By law, any surplus revenue they collect beyond what they need to pay out current benefits must be invested in special, non-marketable Treasury securities.
Oh.
So it's essentially an accounting mechanism representing money the government owes to these specific programs to cover their future obligations, like paying future Social Security benefits. It's an internal IOU.
Okay, that makes more sense. Debt held by the public, borrowed from outside, and intergovernmental debt owed internally to trust funds. Has one component been growing faster than the other lately?
Yes. In recent years, debt held by the public has definitely been the primary driver of the overall national debt growth.
Why is that?
As we discussed, it's largely due to the need to borrow these vast sums from external sources, the public market, to fund those large budget deficits, particularly during the pandemic and other periods of increased spending or reduced tax revenue.
Right. Borrowing from investors, banks, foreign governments.
Exactly. Intergovernmental debt has grown much more slowly. The revenue flowing into the major trust funds like Social Security hasn't increased at nearly the same rapid pace as the government's overall spending needs that drive the public borrowing.
And all this borrowing, especially the debt held by the public, means the government has to pay interest, right? That must be a significant cost these days, especially with interest rates having gone up.
It absolutely is, and it's becoming a much bigger issue now. Just like you pay interest on your mortgage or your credit card balance, the government pays interest to the holders of its Treasury securities, the people and institutions who lent it money.
And that's paid out of the federal budget.
Yes, it's a mandatory spending item in the budget. For many years, actually, even as the total debt grew substantially, the actual dollar amount spent on net interest payments remained relatively contained.
Why was that if the debt was growing?
Largely because we were in a prolonged period of historically low interest rates following the 2008 crisis, and also because of the market's strong confidence in the U.S. government's ability to pay, which kept borrowing rates low.
But that's changed recently.
Dramatically.
Yeah.
With the Federal Reserve increasing interest rates significantly starting in 2022 to combat high inflation, the cost of borrowing for the government has gone up considerably.
Because new debt costs more to issue, and older debt matures and needs refinancing at higher rates.
Exactly. As the Treasury issues new bills, notes, and bonds, it has to offer higher yields to attract investors in the current rate environment. And as existing lower-yielding debt matures, it needs to be replaced with new, more expensive debt. So the amount the government spends just on interest payments is now increasing substantially. It's becoming a rapidly growing line item in the federal budget.
That increase in interest cost is a huge point, with potentially major long-term implications. But let's circle back to the plumbing, the mechanics of how the government actually does the borrowing. You mentioned Treasury auctions are the key mechanism. How does that process actually unfold?
Right. These auctions are the primary way the Treasury sells its newly issued bills, notes, and bonds to the market. And as we touched on earlier, the goals are really clear.
Minimize cost, ensure competition, support the secondary market.
You got it. Borrow at the lowest cost over time, ensure competitive bidding from a wide range of buyers, and support a healthy liquid secondary market for those securities once they're issued.
Who exactly participates in these auctions? Is it just the biggest banks and financial institutions?
Well, the major institutions certainly dominate the volume, but it's actually a surprisingly broad group.
Can individuals get involved?
Yes, absolutely. You, as an individual investor, can participate directly through the Treasury Direct website, which is run by the Treasury Department itself.
Okay, and beyond individuals?
Then you have a really wide range of institutional investors. Think mutual funds, pension funds, managing retirement money, insurance companies, sovereign wealth funds owned by foreign governments, foreign central banks holding reserves, hedge funds, university endowments. Lots of different players.
A diverse crowd.
Very diverse. And critically, there's a special group of financial institutions that play a unique and central role. The primary dealers.
Ah, yes. The primary dealers. Heard that term associated with the Fed, too. What makes them so special in this context?
Primary dealers are major banks and securities firms, typically large global institutions that have been specifically designated by the Federal Reserve Bank of New York, the NY Fed, as its main trading counterparties.
Trading counterparties for the Fed.
Yes. They are absolutely essential to the smooth functioning of the US Treasury market overall, and particularly for the implementation of the Federal Reserve's monetary policy through its open market operations when the Fed buys or sells treasuries to influence interest rates. They have a close, ongoing operational relationship with the New York Fed's trading desk.
And part of that special relationship involves specific responsibilities when it comes to Treasury auctions.
Precisely. This is one of their core defining responsibilities. Primary dealers are obligated, it's not optional, to participate actively and competitively in all Treasury auctions.
All of them. Wow.
All of them. They are expected to bid pro rata.
Pro rata. What does that mean?
It means they are generally expected to bid for a portion of the total amount being auctioned that is roughly proportional to their size and activity level relative to the other primary dealers. So the bigger players are expected to put in bigger bids consistently.
Okay.
And importantly, they're expected to submit bids at prices or yields that are reasonably competitive compared to where similar securities are trading in the market before the auction happens. They can't just lowball everything.
So this requirement ensures there's always a baseline level of demand and price competition in every single Treasury auction.
Exactly. No matter the market conditions, even if markets are volatile or uncertain, the Treasury knows it will have this core group of large obligated bidders showing up and putting in competitive bids. It provides stability and ensures the auction doesn't fail.
So they're not just optional participants hoping for a good deal. They're really essential players with specific obligations. What else is required of them beyond just bidding in auctions? That sounds like a big job already.
It is, but their role extends far beyond just bidding in the auctions themselves. They act as key market makers in the secondary market.
Meaning they stand ready to buy and sell.
Yes, they provide liquidity by being ready to quote prices and trade treasury securities and often other related securities like agency mortgage-backed securities throughout the trading day. This helps ensure smooth trading for everyone else in the market.
Okay.
They're also expected to participate consistently and competitively in the New York Fed's open market operations, as I mentioned. They're the firms the Fed directly trades with to implement policy.
Right.
They're also eligible to use key Fed facilities, like the Standing Repo Facility, SRF, and the Overnight Reverse Repo on RRP facility. In fact, they're actually expected to use these facilities periodically, at least twice every 6 months, partly to demonstrate their operational capability and readiness to act as counterparties to the Fed when needed, especially during times of stress.
Operational capability, what does that involve exactly?
Testing systems. Yeah, it means maintaining really robust systems and internal processes to handle large volumes of complex transactions reliably, accurately, and quickly, even under stressful market conditions. They need to participate in exercises the Fed runs to test their readiness and their technology, especially when the Fed updates its own trading platforms. They need backup systems, disaster recovery plans.
That's pretty rigorous.
It is. And critically, they also provide vital market intelligence back to the New York Fed's trading desk.
How so?
They submit regular, detailed reports on their trading activity, their positions, and their financing activities. They also respond to surveys and engage in ongoing dialogue with the Fed staff, giving the Fed crucial insights into market conditions, supply and demand dynamics, investor sentiment, potential risks, basically providing market color. This information is invaluable to the Fed in understanding how its policies are actually impacting the financial system in real time.
That's a really demanding list of requirements. What does it take for a firm to even qualify to become a primary dealer? It can't be easy.
No, it's definitely not easy. The requirements are quite rigorous, and they're designed to ensure that only financially strong, operationally sound firms with a significant established presence in the Treasury market can earn this designation.
Like capital requirements.
Yes, substantial capital is key. For broker-dealers, the requirement is net regulatory capital of at least $50 million. For banks, it's even higher, at least $1 billion in Tier 1 capital.
So only big, well-capitalized players need apply.
Pretty much. And they also have to demonstrate that they are already significant market makers in U.S. government securities. Typically, they need to show at least a year of substantial activity and consistently maintain a minimum market share, something like 0.25% or more of the total trading activity among all primary dealers.
So you have to be a big player already before you can even be considered to become a primary dealer.
Exactly. You have to prove your commitment and capability first. They must also demonstrate they have the capacity and the willingness to bid competitively pro rata in all the auctions, as we discussed, and that their bids are generally consistent with prevailing market levels.
What about the operational side?
That's huge, too. They need strong, reliable back-office operations, capable of processing and settling huge volumes of trades accurately and efficiently every single day. And they need robust business continuity and disaster recovery plans, often with geographically diverse backup sites, to ensure they can continue operating even if there's a disruption.
Any other hurdles?
Yes. If the firm is a branch or subsidiary of a foreign bank, their home country supervisor must generally offer reciprocal opportunities to U.S. firms in their own government debt markets. It's a status earned through significant, ongoing commitment and proven capability.
Can you give us a sense of some of the firms that hold this designation? Are they household names?
Many of them are, yes. The list includes many of the largest, most well-known global financial institutions. You'd find names like JP Morgan Securities, Goldman Sachs, Morgan Stanley, Citigroup Global Markets, BofA Securities, which includes the old Merrill Lynch primary dealer business.
Okay, the big U.S. banks.
Right. And major international players, too, like Barclays Capital from the UK, Deutsche Bank Securities from Germany, BNP Paribas and Société Générale from France, UBS from Switzerland, Nomura and Daiwa and Mizuho from Japan, RBC and BMO and Scotiabank from Canada. It's a global group.
So firms like Cantor Fitzgerald, Jefferies, Wells Fargo Securities, TD Securities, HSBC, Santander and NatWest. They're on the list too.
Yes, exactly. Those are all currently designated primary dealers as well, alongside others like ASL Capital Markets and SMBC Nikko Securities. It's quite a roster, currently around 25 firms or so.
That's quite a list of major players. Does that list ever change? Or once you're in, you're in?
Oh, it definitely changes. And actually, observing the changes in the list over time can tell you a lot about the evolution and consolidation within the financial industry itself.
How so?
Well, firms can be added if they meet all those demanding criteria and apply successfully. And firms can be removed if they no longer meet the requirements, if they choose to withdraw from the business, or if they are acquired by another firm.
Any famous examples?
Sure. Probably the most notable removals happened during the 2008 financial crisis. We saw the failure and subsequent removal of both Bear Stearns, which was acquired by JP Morgan, and Lehman Brothers, which famously went bankrupt, from the primary dealer list.
Right. Those were seismic events.
They were. More recently, Credit Suisse's New York branch was removed in June 2023 following its troubles and acquisition by UBS. On the addition side, SMBC Nikko Securities America was just added in January 2025, and mergers often lead to name changes on the list, like when Bank of America acquired Merrill Lynch, the primary dealer entity eventually became BofA Securities. So it's definitely a dynamic list reflecting the shifting landscape of global finance.
Very interesting. So with these primary dealers and all the other participants ready to go, let's walk through the steps of the auction itself. How does it actually begin?
Okay. The process formally starts when the Treasury publicly announces that it's going to option a new issue of bills, notes, or bonds, or sometimes reopen an existing issue to sell more of it. They announce the date, the amount they plan to sell, the specific security details.
And once that announcement is made?
Once that announcement is out there, a really fascinating and important market activity begins even before the official auction takes place. It's called when-issued trading.
When-issued trading. Trading a security that doesn't technically exists yet, or at least hasn't been officially sold by the Treasury. That sounds a bit strange.
It does sound a bit strange, maybe counterintuitive, but it's incredibly important and insightful for the market. Market participants, dealers, investors start trading the security based on the Treasury's announced terms before the auction hammer actually falls. They're essentially trading contracts for the future delivery of that security, assuming it gets issued as planned.
Okay. Why do they do that? What's the purpose?
The crucial purpose is price discovery. This when-issued trading activity creates a market consensus, a collective judgment, on the expected price or yield for that new security leading right up to the actual auction time.
So it helps everyone figure out what a fair price might be before they have to bid.
Exactly. It adds a huge amount of transparency and helps inform the competitive bidding process. Large bidders, especially the primary dealers who are obligated to bid competitively, look very closely at the levels where the security is trading in the when-issued market.
Like a real-time gauge of demand.
Precisely. It provides a real-time gauge of market demand and expected clearing levels. This helps them determine the competitive bids they should submit in the auction to be successful, while still aiming to get the best possible price or yield for themselves or their clients. It reduces uncertainty going into the auction.
That seems really valuable.
It is, and it's a testament to its importance that when-issued trading actually has this interesting history. It was banned by the Treasury for a period in the past.
No, really?
Concerns about potential manipulation, I believe. But the ban was later lifted because regulators in the Treasury realized that prohibiting it actually hindered efficient price setting and market function. It made the auctions less efficient, not more. They concluded it was unnecessary regulation that was actually counterproductive.
Fascinating. Okay, so the when-issued market helps everyone figure out a fair price range. Then comes the actual bidding day, auction day. How do people submit their bids to the Treasury?
There are two main types of bids that the Treasury accepts in its auctions.
And I assume there's a relatively simple way for individual investors like me to participate.
Yes, absolutely. That's the non-competitive bid. This is the most common way for retail investors and sometimes smaller institutions to participate, often through that Treasury Direct website we mentioned.
How does a non-competitive bid work?
When you submit a non-competitive bid, you specify the amount of the security you want to buy up to a certain limit, but you agree up front to accept whatever yield, price, or discount rate is determined by the competitive bidding process at the auction's conclusion.
So you don't get to name your price.
Correct. You don't specify a price or yield. The key benefit here is that if you submit a valid non-competitive bid within the limits currently, $10 million for most securities per Treasury Direct account per auction.
$10 million.
Yeah.
Okay, generous limit for retail.
Right. You are guaranteed to receive the security you bid for. You prioritize getting the security, getting your order filled, over trying to control the exact price you pay.
All right, so guarantee the quantity, except the market-determined price. The big institutions, the primary dealers, they must use the other type.
Correct. Larger investors, including the primary dealers and other major institutions, primarily submit competitive bids.
And how are those different?
With a competitive bid, you specify both the quantity of the security you want to buy and the specific yield for notes and bonds, or discount rate for bills that you are willing to accept. You're naming your price, essentially.
So you're trying to get the best possible price for yourself.
Exactly. The goal here is to get the security at the most favorable rate possible. However, there's no guarantee your bid will be accepted if your specified rate isn't competitive enough relative to all the other bids submitted. If you bid too low a yield, too high a price, you might miss out.
So there's a trade-off. Potentially better price, but risk getting nothing.
That's the trade-off. Bidding for both types, non-competitive and competitive, typically closes at a specific time on the auction day, usually 1 p.m. Eastern time for most securities.
Okay, so bids are submitted by 1 p.m. The Treasury now has this mountain of bids, both non-competitive and competitive. How do they sort through all of this to determine who wins, how much they get, and what the final price or yield for everyone is?
This is where the current single-price auction format, also sometimes called a uniform price or Dutch auction format, comes into play. The Treasury has used this method for almost all its securities since 1992.
Single price format since 92, how does it work?
Okay, first, they take the total amount of securities being offered in the auction. Let's say they're selling $50 billion of 10-year notes. They subtract the total dollar amount of all the valid non-competitive bids they received.
Because those are guaranteed to be filled.
Exactly. Let's say non-competitive bids totaled $5 billion. That leaves $45 billion to be awarded through the competitive bidding process.
Okay, $45 billion left for the competitive bidders. Now what?
Now they look at all the competitive bids they received. They arrange these bids in order, starting from the most favorable bid to the government.
Most favorable meaning?
For notes and bonds, that means starting with the bids specifying the lowest yield, which corresponds to the highest price, and moving up towards higher yields. For bills, it's the opposite, starting with the bids specifying the highest discount rate, lowest price, and moving down towards lower discount rates.
Okay, so they rank them from best offer for the Treasury downward.
Correct. They then start accepting bids, filling them in full, starting at the most favorable rate and moving down the ranked list towards higher yields for notes bonds or lower discount rates for bills until they have accepted enough bids to sell the total remaining amount, that $45 billion in our example.
What happens when they hit the exact amount they need to sell?
The yield or discount rate of the highest yield accepted bid that allows them to sell the full amount becomes the key determining rate for the auction. This rate is known as the stop or the stop-out rate. It's the marginal rate, the rate at which the auction cleared.
The stop rate. Okay. And then the single price part comes in. How does that work?
This is the really crucial feature that distinguishes this format from older methods. Once that stop rate is determined, all winning bidders, both the non-competitive bidders and all the successful competitive bidders, receive the security at a single price that is calculated based on that stop rate.
Wait, even the competitive bidders who offered a better deal for the Treasury, like a lower yield than the stop rate?
Yes. Even if you submitted a competitive bid with a yield significantly lower than the final stop-out yield, you don't pay the higher price corresponding to your lower yield. You still get the security at the same price as everyone else, the price determined by that highest accepted yield, the stop rate.
Huh. So everyone pays the same price, which is essentially the least favorable price, highest yield, that was accepted in the auction.
That's exactly right. Bids with yields below the stop rate are filled in full, but at the stop rate's price. Bids submitted with yields above the stop rate are rejected. They get nothing.
What if there are a bunch of bids exactly at the stop yield?
Good question. If the total amount bid exactly at the stop yield exceeds the remaining quantity the Treasury needs to sell to reach its target, $45 billion in our example, then those bids at the stop yield are typically filled on a pro rata basis, meaning each bidder at the stop gets a percentage of the amount they bid for.
Okay. And for a new note or bond, how is the actual coupon rate set? Is it the stop yield?
Not quite. If it's a brand new coupon-bearing security, the Treasury sets the actual fixed coupon rate for the life of the bond based on the stop yield, but it's rounded down slightly. Specifically, it's set at the highest 18th of a percentage point increment, like 4.125%, 4.250%, 4.375%. That results in an average auction price no higher than 100% of the principal amount. Par value. Usually it results in a price just slightly below par.
Okay, that's a bit technical, but the core idea is everyone winning pays one price based on the highest accepted yield. Why did they switch to this single price format back in 1992? What was the old way?
This was a really major change in how Treasury auctions work. Before 1992, the Treasury primarily used a multiple price auction format, often called a discriminatory auction.
Multiple price. How did that work?
In that older format, successful competitive bidders actually paid the specific price or received the specific yield discount rate that they had bid. So if you bid a very low yield, high price, and won, you paid that high price. If someone else bid a slightly higher yield, lower price, and also won, they paid their lower price. Different winners could pay different prices for the exact same security in the same auction.
That sounds potentially unfair, or at least complex.
It could lead to strategic behavior. The switch to single price was prompted largely by some market issues and a bidding scandal involving Salomon Brothers in the Treasury market back in 1991. That event highlighted potential problems with the multiple price format, particularly concerns about market manipulation and strategic bidding designed to disadvantage smaller players.
So what was the thinking behind the single price format fixing that?
The main rationale, supported by academic studies and game theory analysis at the time, was that the single price format encourages bidders to be more aggressive and bid their true value or their reservation yield.
Reservation yield.
Meaning the absolute highest yield, lowest price, they are actually willing to accept to buy this security. In a multiple price auction, bidders might be hesitant to bid their true reservation yield. They might hold back and bid a slightly higher yield, lower price, than necessary because they're worried about the winner's curse.
winner's curse.
Yeah, the risk of bidding too aggressively, too low a yield, too high a price, and ending up paying significantly more than others if the auction ultimately clears at a higher yield, lower price. You win, but overpay relative to the market clearing level.
Ah, I see. So the single price removes that fear.
That's the idea. By making everyone pay the same single price determined by the marginal bid, the stop rate, the single price format aims to remove that strategic uncertainty and the fear of the winner's curse. Bidders know they won't be penalized for bidding aggressively if the stop ends up higher.
So they're more likely to just bid what they truly think it's worth.
Theoretically, yes. The hope is that this leads to more competitive bidding overall, pushing bids closer to the true market value, and potentially resulting in lower average borrowing costs for the government over time. While definitively proving a significant cost reduction has been complex and debated in studies, the single price format is widely considered to be more transparent, fairer to participants, and less susceptible to manipulation.
It sounds like a clever way to encourage participants to reveal their true willingness to pay, or at least bid closer to it. Now, are there any rules to prevent any single participant, even a primary dealer, from just dominating an auction and buying up almost everything?
Absolutely. That's critical for ensuring the market remains competitive and liquid and avoids corners or squeezes. The Treasury has restrictions specifically designed to prevent any single bidder or related group of bidders from accumulating too large a position in a single auction.
What's the main limit?
The primary limit is that a single bidder cannot be awarded more than 35% of the total amount offered to the public in any single auction.
35%. That seems like a reasonable cap.
It is, but there's a very important nuance. That 35% maximum award limit can be further reduced based on that bidder's existing holdings and exposure to that specific security outside of the auction itself. They look at the bidder's reportable net long position.
Net long position. What does that include?
It includes things like their holdings of contracts to buy that specific security in the when-issued market we talked about earlier.
Okay.
Their positions in related futures contracts that deliver that security, and even their existing holdings of previously issued securities that have the same unique identifying number, the CU-SIP number, if it's a reopening of an older issue.
So if a big institution already owns a lot of a certain bond or has bought a lot in the when-issued market before the auction, they might be limited to buying less than 35% in the actual auction.
Exactly. The rule is designed to prevent a single firm from cornering the market in a specific security or allowing one entity to gain undue influence over its price and availability, especially around the time of issuance.
Has this always been the rule?
This type of restriction has roots going back decades. It evolved significantly after an incident back in 1962 where one particular firm submitted bids for an exceptionally large portion of a T-bill auction, raising concerns. The rules around calculating that net long position have been refined quite a bit over time, especially to adapt to the growth of new trading instruments like Treasury futures and strips.
Strips, what are those?
Strips stands for Separate Trading of Registered Interest and Principal of Securities. It's a program where the individual coupon payments and the final principal payment of a Treasury note or bond are stripped apart and sold as separate zero-coupon securities. They needed to account for positions in these too.
Okay. So the rules had to keep up with financial innovation.
Precisely. And they also adjusted how existing holdings impact the limit, especially for these reopened securities. For instance, there was a rule change back in 2001 that clarified things. The goal was to ensure that simply holding a large amount of an original issue didn't automatically and unfairly restrict a firm's participation in a much smaller reopening of that same security later on, as long as their overall position wasn't becoming disproportionately large relative to the total outstanding amount.
So constant adjustments and clarifications to keep pace with how the market actually operates and trades these securities.
Yeah.
What about the details of the bids themselves? Like how precise do the yield bids need to be?
That's also evolved over time, generally towards greater precision. When competitive bidding for notes and bonds first shifted from being submitted in terms of price to being submitted in terms of yield back in 1974.
They used to bid price, now they bid yield.
Mostly yield now for notes and bonds, yes. Back then, those yield bids were originally required to be in increments of whole basis points. A basis point is 1/100%, so like 4.01%, 4.02%, etc. Similarly, for bills, when they started bidding based on discount rates in 1983, it was also initially in whole basis points.
Let that change.
Yes. Over time, to better align with how these securities actually trade in the secondary market, where quoting is much finer, and also to encourage more precise competitive bidding, the required precision was increased. For notes and bonds, it moved to increments of 1/10 of a basis point, 0.001%, back in 1995.
So much finer increment.
Much finer. For shorter-term bills and those cash management bills, CMBs, it later became increments of 1/2 of 1 basis point, 0.005%. These changes, while they might seem minor, were aimed at making the bidding process more efficient, reducing the likelihood of large numbers of bids clustering at a single whole number, and potentially capturing slight price advantages for the Treasury by allowing finer competition.
Makes sense. And how has technology changed this whole bidding process over the years? I can't imagine they're still mailing bids or running them over by hand anymore.
Oh, the technological shift has been absolutely profound. It's been a massive leap forward in efficiency and speed. Believe it or not, before the early 1990s, the bidding process was largely paper-based.
Seriously. Paper forms for billions of dollars.
Seriously. Dealers would literally prepare paper bid forms, often with multiple copies, and have runners physically deliver them to the Treasury Department in D.C. or to the regional Federal Reserve banks, like the New York Fed, before the option deadline.
That sounds incredibly slow and frankly stressful. What if the runner got stuck in traffic?
It was. And think about the primary dealers trying to get the absolute latest market information before submitting their final bids. There are famous stories of dealer representatives literally waiting in the lobbies of the New York Fed building, getting last-minute instructions over the phone from their trading desks about the final yield to put on the form, scribbling it down, and then physically handing in the paper bid right at the deadline buzzer.
Wow, that's a world away from today.
Completely. And processing all those thousands of paper bids took hours. The market would be left in suspense for a long time after the bidding closed, waiting to find out the auction results, the stop rate, the amount awarded, etc.
So how did electronics change that?
The shift to electronic submission systems, primarily through something called TAPS Link, the Treasury Automated Auction Processing System Link, completely revolutionized this in the 90s. There were different versions, TPS Link V1 for most institutional bidders and a higher speed V2 specifically for the high-volume primary dealers.
So bids could be sent electronically.
Yes. Bids could be submitted securely and electronically right up until a deadline. The system could then process these bids much, much faster. Instead of hours, the auction results are typically calculated and announced publicly, usually within an hour or even less after the bidding closes.
That's a huge improvement.
Huge. It dramatically reduced the period of uncertainty for bidders and the market overall. It increased operational efficiency and accuracy and made it much easier for more firms, especially those not physically located near a Fed bank, to participate actively right up to the close. And of course, the later introduction of online bidding through Treasury Direct did the same for retail investors, making it accessible to anyone with an internet connection.
Okay, so the securities have been announced, the when-issued market has done its price discovery, the bids are in electronically, the winners have been determined using the single price method, the stop rate and prices are set. Now comes the final step. The actual delivery of the securities to the winners and the transfer of money to the Treasury, the settlement process. With these massive volumes, potentially hundreds of billions changing hands, how does that plumbing work, especially for the big players like the dealers?
Right. Settlement is the critical final piece. For individual investors buying through Treasury Direct and maybe some smaller institutions dealing directly, the securities are delivered electronically to their accounts and the funds are debited directly. Pretty straightforward.
But for the big guys, the primary dealers and other large institutions?
For the vast majority of the volume, particularly the huge awards going to the dealers, which, as you said, can be around 75% or more of a typical auction, the settlement process is handled through a crucial piece of market infrastructure, the Fixed Income Clearing Corporation, or FICC.
FICC. Okay, what's their specific role in this picture? Are they part of the Fed or the Treasury?
No, FICC is actually a subsidiary of the Depository Trust and Clearing Corporation, DTCC, which is owned by the financial industry itself. FICC acts as the central clearing counterparty, or CCP, for the vast majority of U.S. government securities transactions that happen in the secondary market.
Central clearing counterparty. What does that mean they do?
It means they step into the middle of trades between their members, which include the primary dealers and many other large banks and brokers. When two FICC members agree to a trade, FICC effectively becomes the buyer to every seller and the seller to every buyer.
Why is that structure useful?
It's crucial for reducing risk in the market, specifically counterparty risk, the risk that the person on the other side of your trade might default before settling. FICC guarantees the completion of trades between its members within its risk management rules, significantly reducing systemic risk.
Okay, so FICC handles regular trading. How does it get involved with the auction settlement?
Since 1994, FICC has offered a specific service called the Auction Takedown Service that is absolutely key to settling the auction awards for its dealer members.
Auction Takedown Service. What does that service do specifically for the dealers who won securities in the auction?
Essentially, it integrates the securities a dealer is awarded in the Treasury auction directly into FICC's regular settlement processing. It combines the auction award with all the other trades that the dealer might have in that exact same security that are scheduled to settle on the same day.
Other trades like?
Like those when-issued trades we talked about, where the dealer might have already agreed to sell some of the security they just won in the auction, or maybe repurchase agreements, repos, involving that security. FICC takes the auction award and nets it against all these other obligations the dealer has in the same CUSIP.
Nets it out, meaning they only settle the final difference, not every single individual trade or the full auction amount separately.
Exactly. That's the power of net settlement. In a gross settlement system, every single transaction has to be settled individually. Dealer A delivers 100 to Treasury, Dealer A delivers 80 to Dealer B, etc. With net settlement through FICC, FICC looks at all of a member's relevant transactions for a given security settling on a given day and calculates their final net position.
So what do they actually owe in total securities, and what are they owed in total?
Precisely. Instead of potentially dozens or hundreds of separate deliveries and payments moving back and forth, FICC facilitates the exchange of only the final net amounts of securities and cash between its members and indirectly with the Treasury via its members.
Can you give an example?
Sure. Let's say a dealer wins $100 million worth of bonds in the auction. But in the when-issued market before the auction, they had already agreed to sell $80 million of those bonds to other FICC members for settlement on the same day.
Okay.
Through FICC's auction takedown and netting service, FICC's system nets this all out. Instead of the dealer having to receive $100 million from the Treasury and then separately deliver $80 million to its counterparties, the dealer might only receive and settle for a net amount of $20 million worth of bonds via the FICC system.
Wow, that sounds vastly more efficient and less risky. Fewer moving parts.
It is exponentially more efficient, yes. And critically, as you said, it dramatically reduces risk, especially settlement risk and systemic risk. Think about the alternative. Before FICC's netting service for auctions was robust, if a dealer won a huge auction award and had already forward sold those securities to many other parties, but then that dealer suddenly became insolvent before they could actually redeliver the securities from the auction.
It would cause a chain reaction of failures.
Exactly. It could create chaos and potential settlement defaults rippling through the market. FICC, by acting as that central counterparty and guaranteeing settlement for trades between its members, backed by margin collateral and a guarantee fund, absorbs much of that counterparty risk and drastically simplifies the overall flow of securities and cash. The auction takedown service essentially integrates the initial distribution from the Treasury into this much safer and more efficient netting framework.
That really highlights the importance of this kind of background infrastructure, like FICC, for managing the sheer volume and complexity of the Treasury market. It's not just about the auction itself.
Absolutely not. The settlement is just as crucial. The evolution from those old manual paper-based processes and gross settlement systems to today's world of electronic bidding, single price auctions, and centralized net settlement through FICC reflects this continuous drive over decades to improve the efficiency, the speed, and critically, the safety and reliability of the U.S. government securities market.
And all these operational advancements ultimately support the Treasury's main goal, right?
Yes, they're directly aimed at supporting the Treasury's primary objective, minimizing the total cost of borrowing for the taxpayer over time. They do this by making the market for U.S. debt as attractive, predictable, transparent, liquid, and low risk as possible for the widest possible range of global investors.
Okay, so bringing it all back to the listener now. We've gone really deep into the nuts and bolts here. Bills, notes, bonds, deficits, debt to GDP ratios, the critical role of primary dealers when issued trading, the logic of single price auctions, and the vital plumbing of FICC settlement. Why does understanding all this complex machinery really matter to you, the person listening right now?
Because this entire intricate, sophisticated, constantly evolving system is fundamentally what allows the United States government to reliably raise the trillions of dollars it needs day in and day out, week after week, year after year.
To do everything it does.
To operate the country, yes. To fund all these essential programs and services we talked about. To invest in the future through infrastructure or research. And simply to meet its ongoing financial obligations. And it does this thanks to this highly developed system, generally at the lowest possible cost to the taxpayer over the long run.
And that cost, the cost of government borrowing, ultimately impacts everyone, doesn't it?
It absolutely does. If the system were less efficient, if it were less competitive, if investors perceived it as being significantly riskier, the government would likely have to pay higher interest rates to convince people to lend it money.
And higher borrowing costs for the government mean?
It would mean a larger and larger portion of the federal budget would have to be dedicated just to paying interest on the national debt. That potentially leaves less room for funding other spending priorities, whether that's defense, education, healthcare, infrastructure, you name it. Or, alternatively, it could necessitate higher taxes in the future to cover those ballooning interest payments.
So the smooth functioning of these auctions is really foundational.
It really is. The liquidity provided by the primary dealers acting as market makers, the risk management and efficiency brought by FICC's central clearing and netting. These are foundational pillars supporting the stability not just of the U.S. financial system, but given the dollar's global role and the importance of treasuries as a benchmark asset, the global financial system as well.
And just to reiterate a point you made earlier, while we emphasize the no default risk of holding treasuries to maturity, the fact that their market value can fluctuate, sometimes significantly, before maturity based on changes in interest rates is a direct outcome of how this enormous liquid market functions day to day, influenced by all the supply and demand dynamics and auction processes we've discussed. It's not risk-free if you might need to sell early.
An extremely important distinction for any investor to understand.
And finally, just to layer one more piece on top of all this sophisticated operational and market mechanics, there's the political reality of the debt ceiling that periodically comes up.
Yes, the debt ceiling. That's a whole other layer of complexity, isn't it?
How does that fit in?
Well, the debt ceiling is a statutory limit set by Congress, completely separate from the Treasury's operational borrowing process, on the total amount of national debt the U.S. Treasury is legally allowed to have outstanding at any one time.
So even if the Treasury has the operational capacity and a market ready to lend it money through auctions to fund spending, the Congress itself is already authorized.
Exactly. Even if the spending is legally appropriated, reaching the debt ceiling means the Treasury cannot issue any new net debt. It can only issue new debt to replace maturing debt without Congress first acting to raise or suspend that limit.
And that creates periodic standoffs and uncertainty.
It certainly does. While the U.S. has always, so far, managed to avoid a technical default on its payment obligations through various extraordinary measures and eventual legislative action, a failure to address the debt ceiling in a timely manner would fundamentally disrupt this entire borrowing mechanism we've spent the last while describing. It would prevent the Treasury from holding necessary auctions,
which could have severe consequences.
Potentially severe and highly unpredictable consequences for the Treasury market itself, for interest rates across the economy, for the government's credit rating, and for the broader U.S. and global economy. It adds a layer of political risk on top of the operational system.
Okay, wow. That's a lot to digest. Let's try to recap this deep dive. We started with the almost unimaginable scale of the U.S. national debt and set out to explore how the government actually borrows all that money.
Right. We broke down the main tools it uses, the Treasury bills, notes, and bonds, explaining how they differ primarily in their maturity, short, medium, long term, and how they pay interest, discount for bills, semi-annual coupons for notes and bonds. And we stressed their fundamental safety if held to maturity, being backed by the full faith and credit of the U.S. government.
We then traced the origins of that massive national debt back to the accumulation of past annual budget deficits when spending exceeds revenue. We talked about how major events like wars, economic crises, and especially the recent pandemic caused debt levels to spike significantly.
And we mentioned the debt to GDP ratio as a more insightful way to gauge the debt burden relative to the size of the economy, noting the U.S. ratio has been over 100% for some time now.
Then we dove into the heart of the borrowing process itself, the Treasury auctions, We learned about the Treasury's key objectives: minimizing cost, maximizing competition, ensuring liquidity.
We unpacked the absolutely crucial roles played by key participants, especially the primary dealers, those major financial institutions designated by the New York Fed with specific obligations to bid competitively in all auctions and provide market liquidity and intelligence.
And we highlighted the vital plumbing provided by the Fixed Income Clearing Corporation, FICC, whose central clearing and net settlement services, including the auction takedown service, bring essential efficiency and risk reduction to the settlement of literally billions, sometimes trillions, in securities trading every single day.
We walked through the auction mechanics themselves. The importance of that pre-auction when issued trading for price discovery, the difference between non-competitive bids, guaranteed quantity, and competitive bids, specifying yield rate, and the logic behind the current single-price auction format, which aims to encourage a more aggressive, truthful bidding and ultimately lower borrowing costs compared to the old multiple-price system.
We saw how the whole system has continuously evolved over decades, adapting rules on things like bidder limits and net long positions, increasing the precision of bids, and, most dramatically, moving from slow, manual, paper-based processes to fast, efficient electronic bidding and settlement.
I think the key takeaway for you listening is that the seemingly simple act of the U.S. government borrowing money is actually supported by this incredibly detailed, dynamic, sophisticated, and continuously improving system. It's a marvel of financial engineering, really.
A system built fundamentally for efficiency, transparency, competition, and stability, operating right at the very core of the world's most important bond market to ensure the government can fund itself reliably day after day.
Which brings us back to that critical point we touched on earlier about the current environment. As the national debt continues its upward trend, potentially for the foreseeable future, and as global interest rates have moved significantly higher than they were for much of the last decade, the cost of servicing that existing debt, the amount the government has to pay out each year just in interest payments, is also increasing significantly. It's becoming a much larger slice of the federal budget pie.
Right. So here's a final, maybe provocative thought for you to consider as we wrap up. What might the long-term implications of this rapidly rising interest cost actually be? How could paying significantly more each year just to service the existing debt potentially impact the government's future spending choices? Could it crowd out other priorities, affect its ability to launch new programs, or even maintain existing ones at current level?
Or, looking at the other side of the ledger, could it ultimately increase pressure for higher taxes on citizens and businesses like you down the road to cover those growing interest payments?
A complex question, definitely, with no easy answers, built on the foundation of the equally complex system we've just spent time exploring.
Absolutely. Something worth pondering as you hear ongoing debates about deficits, debt, and government spending.
Indeed. Well, we hope this deep dive into the sometimes arcane but utterly crucial plumbing of government borrowing has given you a new perspective on those huge debt numbers you hear in the news and how the system behind them actually works. Thanks so much for joining us.
Yes, thanks for listening. Until next time.